the statutory rate is important because in an international economy, if you've got the highest rate, all the deduction birds will flock to your country, and the income birds will flock to the lower tax country. And so we've got a system where we're attracting deductions, particularly for things like interest and royalties, and other countries are attracting income. And this is not a system designed to serve the American public well. And therefore there is, I think, uniform consensus across the political spectrum that the statutory corporate tax rate has to come down. Barack Obama said 28%. Dave Camp, a Republican from Michigan, who was the chairman of the House Ways and Means Committee, said 25%. The current House leadership says 20%. Donald Trump said 15%. The pressure is all downward. And the idea is to get a system where we can attract income and not just deductions. That's point one. I want to make one other contextual point, which gets me back to the General Electric story. So a couple of years ago, now almost 4 years ago, the prime ministers of the G20 instructed the OECD to investigate base erosion and profit shifting, known in the trade as BEPS, base erosion and profit shifting by multinational corporations. And this is the first time that an OECD tax reform project was instituted and then subsequently received at the prime minister level of the G20. And after a couple of years of discussions, it's interesting because the Treasury, U.S. Treasury's top tax negotiator was fond of saying that every time he was in the room negotiating the BEPS project at the OECD, he felt like everybody at the table was looking at the U.S. to buy the drinks and to pay for the changes. But the basic point is that multinational tax avoidance had become such a political issue that the prime ministers regarded this, and the President of the United States regarded this as an important stimulus to try and get a multilateral solution to income shifting and tax avoidance, which is what the OECD project was about. An Australian tax advisor, Treasury official, said to me that tax avoidance in Australia has become the topic for barbecue conversations. And so when the public is talking about tax avoidance by multinational companies, this is creating huge new political pressures on raising taxes, and in particular on raising taxes on U.S. multinationals by other countries. And so the BEPS project, in some sense, was designed to do that. The state aid work by the European Commission, most recently its multi-billion-dollar assessment against Apple, is being led by a person who's in the European Commission, but who is, at least I understand, hoping to run for political office in Northern Europe soon. And so you have this odd confluence where people are concerned about multinational tax avoidance, but everybody understands the U.S. system is out of sync, that the tax rate is too high, that we've created an invitation to avoidance of our own taxes, and something has to be done. And for the last several years, there is a consensus across the political parties that the time for tax reform is now. The only question is what that tax reform will look like and how it will get through the Congress and be signed by a president. And of course, that was difficult when you had a Democratic president and a Republican Congress. Now it's going to be easy because we've got a Republican president and a Republican Congress, so it should be a walk in the park.
So broadly speaking, I think the consensus is true in one way, which is there's a need to bring down the rate. There's a need to shift away from a worldwide system to a territorial system. That consensus is actually really significant, and it wasn't there, I think, 7 years ago. So that is an achievement. What has happened more recently is there's been a divergence in the potential paths we could take. The Brady-Ryan plan that came out last summer, I think, is not a kitchen renovation or a gut rehab. It's a takedown of the house and a rebuilding from the ground up. That's one approach, and we can talk about that. It does bring the rate down. It does basically shift to territoriality. It just does a lot more than that. And then there's what is now considered a more moderate approach, which 8 months ago was a radical approach, which is bring down the rate considerably, switch to territoriality, fund that so it can be done in a revenue-neutral manner with a variety of provisions that might include repealing interest deductibility, as well as other possibilities. So the real fork in the road we're faced with on the business side is something that's more akin to fundamental reform, which is the Brady-Ryan plan, which is fundamentally a use of the corporate sector to achieve a consumption tax. I think that's the easiest way to think about it. Or you stay within the paradigm of the income tax. You stay within the paradigm of the corporate income tax, and you say, we want to tax corporate income, and we want to do it in basically the way we've been doing it, but with some bells and whistles. So that's the fork in the road. I think what is interesting about this, per Michael's comment, it has become a global issue, and people are paying attention to it more and more. But that is in part a reflection of just the general debate on income inequality. Right? So a lot of the corporate tax debate now is about having rich fat cats pay the bill. And it is politically salient for that reason.
So under the U.S. corporate tax system, when companies earn active business income abroad, they're not taxed in U.S. on that income until they bring it home. So that doesn't mean that the actual cash cannot come home. It's that for tax purposes that these earnings, the foreign earnings, are not repatriated back home. So the reason it's so visible is because these earnings that are unrepatriated for foreign earnings are listed sort of in a special way on financial accounting statements as being permanently reinvested abroad. And therefore, you can open, the financial statements of major U.S. multinationals, and you can just see how much of these permanently reinvested earnings do they have abroad. And all of that is eventually, under the current system, is going to be subject to tax when it is brought into the country, but eventually maybe enormously, very, very long time ago. The reason it's so important now is that because part of this discussion that is being now had about corporate tax reform, there is under everyone's proposals, Obama and Trump and House Republicans, everyone wants a piece of these earnings immediately. So like a one-time tax and then some kind of a transition to a different regime. And depending on, obviously, on how much, what the tax rate, there is a conversation about whether you tax cash differently from reinvested earnings and assets, but that's a source of significant revenue right now, and it was somewhat of a source of revenue in 2004, and the law was that the multinationals could bring back some of these earnings. It was a holiday. So technically, when these earnings are repatriated, then or now or in the future, they'll be subject to a U.S. corporate tax, subject to a credit. So if I earned $100, I was taxed, at 12% in Ireland on that $100. I bring back these earnings. U.S. corporate rate right now is 35%. So the U.S. tax is going to top up from 12 to 35. Okay? So that holiday was a very low rate, a one-time holiday. They were all one time and then one more time. So that was a one-time holiday for companies to repatriate these earnings. And there were some strings attached. And the major string that Jesse already has alluded to is that these earnings brought back were not supposed to be used for distributions to the shareholders and stock buybacks and stuff like that. They were supposed to be used to invest in American jobs. There is no evidence that US tax law succeeded, that Congress succeeded in directing the money one way or the other, okay? So nonetheless, it's still important today because of the revenue effect. Because the rate that is being discussed today as this one-time tax, not only on the earnings that companies decide to bring, but on all of them. Like all that stuff that on
This stuff is still invested
Apple,
overseas, yeah.
whatever it's invested, doesn't matter. All that stuff that sits, like Apple says is permanently reinvested, and Pfizer, and all these multinational companies, we're just going to take all of that and tax it one time at a rate that's higher than 4%. So that's a source of revenue. And then, Trump wants to use it for infrastructure, but it can be used to reduce the rate and so on.